Hi there, this is Kevin with Christensen Financial, and I wanted to give you a few updates on the mortgage industry and mortgage interest rates as the situation with the coronavirus continues to evolve. I hope this message finds you healthy, finds you well, and in a comfortable space. Christensen Financial remains open for business. We've enacted our backup plan, and we have most of our corporate employees working from home while some have decided to still work from the office. Since we're based in Florida, we're used to disruptive events like hurricanes, and so we have the capability to work remotely and still get business done. So we're fully staffed, we're fully operational, and fully ready to continue meeting your mortgage needs. So what is going on with interest rates? Well, you've probably seen the headlines that the Fed lowered rates to 0%. What they actually lowered was the Fed funds rate, which is the rate that banks charge each other to lend reserve funds on an overnight basis. So it's an indirect component of mortgage interest rates, but it doesn't mean that mortgage rates are 0%. The most significant part of the Fed's announcement is that it committed to putting $200 billion back into the mortgage-backed securities market. And this is really what will help interest rates. And what we're seeing this morning as the market opens and as it digests the move is that rates have lowered a good bit from where we ended up on Friday, but they're still slightly off the lowest levels that we reached earlier in the week last week. So here's what I'm telling all of our loan officers. Interest rates are going to continue to be really volatile. That means they may change very quickly, and you may see them change by a good amount on a day-to-day basis. Right now, after the Fed made perhaps the biggest move in its history, we're probably sitting at about as good as they're going to get without there being some other major move or announcement. So it's a good probability that the Fed is really keeping an eye on mortgage interest rates and will try to keep some stability in the prices. In the longer term, that may help interest rates, but it probably means that they won't go a whole lot lower, in my opinion, than where they're at. So the bottom line is that a typical 30-year mortgage in the threes is historically low, and it's an awesome interest rate. So whether they go slightly up or slightly down over the next bit here, it's still creating a tremendous opportunity to lock in cheap money for the long term. So if you own a home and you have credit card debt, consolidating from average interest rates in the teens into the threes can be life-changing. And if you're renting a home, but you'd like to build equity and position yourself for long-term financial success, you can afford more home right now than basically any time in the past decade. And if you're already working on your loan and you're wondering, should I lock in the rate or try to wait for a better rate? It might be best to just play it safe and lock in a rate you're going to be happy with for the next 2, 5, or 10 years from now. But if you're comfortable taking some risk and you don't mind minute-by-minute changes, then go ahead and float. But personally, I think the floor isn't much lower at this time. So Christensen Financial, we've been around for close to 19 years. We survived the financial crisis and we thrived in the years after it. We're in a solid position to continue responding to the coronavirus situation as it evolves and wherever that may take the mortgage industry. We do home loans with a human touch, and in no time has that been more important than right now. I encourage you to talk with your loan officer with any questions you may have about the economy and interest rates. With everything changing so quickly, something you read from last week may not even be applicable today. So talk to a Christensen Financial loan officer for more up-to-date information. God bless, and we'll talk to you soon.